Today, we're going to be looking at the components of working capital. And this is such a vitally important topic. The amount of working capital that we compute or calculate in the deal is so vitally important as a business broker because it's really how we are funding the operating engine of the company. And without a sufficient amount of working capital, all sorts of things can go haywire after the transaction is closed and when the new buyer is operating that business. So it's a really important aspect to consider. And it's important to say, how is that going to impact my selling price? Is that working capital going to be included? Is there going to be a target? Is there going to be advice to the buyer? Is there going to be advice to the seller? And when we can identify a sufficient amount of working capital to fund the business as it operates under new ownership, that's super critical. Yes, the lender will provide some information about that, but typically that's very scant, and I say they'll sometimes loan you enough rope to hang yourself as opposed to making it all the way across the chasm. So I don't always rely on the bank to figure out that working capital, and I'll explain why. But today we'll be looking at the components of working capital. Last week we talked about the importance of working capital. Now we'll dive in a little bit deeper and look at the components of that working capital. And let's proceed, shall we? So we're going to be looking at what we call the daily cash flow and the cash conversion cycle method. Yes, working capital can be estimated by simply looking at current assets minus current liabilities, but that's really a liquidity measure. Does the company have enough assets that could be sold in a fire sale to pay off all the current liabilities? Who wants to plan for failure? So let's don't use that method. Another one could be add our accounts receivables minus our accounts payables. That's money that we have lent out to other people, typically at no interest, our customers who have bought goods and services from us. And let's subtract the money that we can borrow from accounts payable, also at no interest. And the difference of those between accounts receivable and subtracting the balance of accounts payable gives us a working capital number. That's a wide scale look at working capital, but how do we use that in a forecast? How do we look and say, if the business is going to do this result, how do I know how much working capital I'm going to need before I launch this? As they used to say, growth is sometimes the fastest way to grow broke. So we have to watch out for that to say, how much growth can we really support by either internally generating that cash flow or by externally, and this is what we call a plug figure, externally outside of the company, as in the owner contributes cash or the owner borrows cash from another source. And we don't really want to rely on that at this point either. So understanding the cash conversion cycle and the working capital assessment is really important because that's what will help us understand how much growth that a company can have. The method that we're using, again, is the daily cash outflow times the cash conversion cycle. So we'll get our daily cash outflow in terms of dollars, and then we'll know what our conversion cycle is, and that's the difference between when cash is going out and when cash is coming in. So as we look at this working capital assessment, let's go ahead and look at the elements. Remember our cash conversion cycle. It's built up of three primary areas. This day's inventory outstanding, that's when I buy inventory and then I sell inventory. The day's sales outstanding, that's when I make a sale and then I receive the cash from my customer. That's my day's sales outstanding, and that's the operating cycle. I get a little bit of help during that operating cycle by something we call the days payable outstanding. And that means that cash doesn't have to go out on the day that I buy it, but rather it's the day that invoice from my provider is due. And so if they give me 10 or 20 or 30 or 40 days, that offsets and shortens this cash conversion cycle. If we were on a cash on delivery or cash at order, we'd have no days payable, and our cash conversion cycle would equal our operating cycle. In this case, we have cash coming in, but cash is not going out for part of that same period. And that's what provides to me that cash conversion cycle. Okay, so let's look at a couple of more items. The source data that we're looking at is simply from the income statement and the balance sheet. And there's only 5 numbers that we need. And all of these things give us a wealth of information. And they are our gross revenue or sales, our cost of goods sold, our accounts receivables, our inventories, and accounts payable. From the income statement and from the balance sheet, that's the source of our information. And there's only 5 numbers in each year that we need to be able to rely on. So let's look at this days inventory outstanding. The days inventory outstanding is a relationship between the cost of goods sold and my inventory. So in 2021, we had a cost of goods sold of $643,000. We had at the end of the year a balance of inventory of $20,887. That means that we turned over this inventory 30.81 times, meaning that we took $643,000 divided by 20,000 and we get 30. And we do that for all years. And we're going to be able to apply this same information into our year 1. So we'll start with this inventory turnover. I turned over my inventory every 30 days. And that's great for an HVAC company with some inventory. That's not very good for a restaurant. Who wants lettuce that's old, right? We want that inventory turnover to be probably on a daily basis on something like that, right? Then we take that same 30.81 and we divide it into 365, and that says that I've got 11.85 days outstanding. I have enough inventory to last me for 11.85 days. To the full year tells us that we have 11.85 days of inventory outstanding, and I have to replace that every 11.85 days. That's going to mean I'm going to need cash to invest in inventory. We're taking it from profit. We have cash, and I have to invest in that inventory. I have to buy $20,000 worth of inventory every 11.85 days. So I'm going to need that cash on hand. Next, we'll look at our days sales. Now we've bought our inventory and now we're going to sell it. We take our accounts receivables and we're doing the same thing. We're going to find the turnover. How often do we collect those $95,000? So the end of the year balance of my accounts receivables was $95,000. My gross revenue was $1,146,000. 1,000,001 divided by 95,000 is 11.97. So I collect after a sale every about 12 days. So I'll take that same number, 11.97, and divide it into, or 365 divided by 11.97 is days sales outstanding, 30.5. That means that it takes on average 30 days for me to collect payment from my customers. And that may be very normal and customary, or it may not. And that depends on the strategy that I have from here, right? My inventory, I bought inventory. It took me a number of days to sell it. It took me a number of days to receive the cash. That's my operating cycle. And so when we look at that, it says that it takes me 42 days if I have to buy inventory and pay cash and then receive money to make payroll, to pay rent, to make loan payments and things like that. So we're going to get a little bit of help in this operating cycle from our accounts payables. And now let's look at that. So here's our operating cycle. Again, this is fleshed out a little bit more. It says that I have to have about $117,000 to maybe $140,000 of cash on hand to fund my operating cycle. And this is a business that's selling for probably around $850,000 as I recall. So it takes money to make money. A buyer's going to buy a business, we'll say, for $850,000, and they're going to need about $140,000 of cash to fund this operating cycle. That's a big number, and that makes a big difference regarding success for the new owner after they've bought the business. Now let's build our days payable outstanding. And how do we do that? We're going to be looking at those same kind of numbers. In this case, we're looking at our cost of goods sold divided by our accounts payable, and that gives us our accounts payable turnover. So now we'll take this cash conversion cycle number and we'll figure out how much cash is going out every day. So we look at a number of things. We look at our cost of goods sold plus all of our other deductions. Remember, depreciation reduces our taxable income, but it's not a cash outflow. So we're going to subtract this 18,000 from these two numbers. So this was about 1,026,000 minus 18,000 means that our annual cash flow for the year was 1,008,771. And you can see how we've calculated it for all years. Now we divide this number by 365 to say, what's my cash outflow every day? And it's about this $3,000 number, right? So now we've put a number to how much cash is going out. And let's see if we can tie this all together. So my cash is going out at $2,700 or $3,000, about $3,000 a day. And it takes me 14 days to have cash come in. That means my working capital assessment is around that $40,000 to $50,000 number. Those are the components. And here we have our elements from our income statement and our balance sheet. Now, the good thing about BizProValue is that we make all the calculations for you, right? All of these calculations, these activity ratio calculations, are automatically calculated for you. All right, both in the historical performance comparison and when we come to our working capital projection. Remember that $49,000 number? Here it is. All right, so that's the number that I'm going to include in my purchase price, because I'm going to give an indication of value on the cash flows, but we're also going to typically include some working capital. This is my year one. I'm taking into consideration the historical performance of the company, and I'm building out this year one performance, right? Valuation is always a prophecy of the future. It's not based on what the company has done in the past. The value of the cash flows are the cash flows that are going to flow to the new owner. And by creating this stabilized operations, it's our best estimate of how this company is going to perform in the future. Here we have our EBITDA and seller discretionary earnings. We can see how that compares to the past. And here you can see that in year one, in this particular case, I was very conservative. I projected a performance a little bit less than what the company had done in the past. So it's conservative. Now, what I like to do is come back to my performance comparison, particularly the graphs, because I can see readily how is EBITDA of my subject company relative to the comparison group. And now in BizProValue, 3 years of comparative data and 5 years of industry data. I filtered this comparison group, and it said that my EBITDA for this subject company of 15.14% of revenue is a little bit more than the midpoint and just under the high point, or the 75th percentile. So this might lead me to determine this business could sell at a premium because it's performing better than the industry and better than the comparison group. So when I come to most probable selling price, I might take this and increase it here, and let's put it at this 65th percentile. This company is tying up a little bit more capital, not quite as much as the industry is, but more than the comparison group. So this company is requiring more capital to operate than my comparison group does. Therefore, I'm going to decrease this multiple a bit. And that's the art of judgment, right? So based on your knowledge and experience, it will help you understand where you want to precisely set these indicators. So here I'm at this 65th percentile, and let's say that we'll leave this at a 75% weighting on EBITDA and seller discretionary earnings. Here's where you see all that, my cash conversion cycle of 14.52 days. I would look at it in my working capital annual, and I get my cash conversion cycle, which is weighted from the historical, and it suggested that 48,000. So when I came to my most probable selling price, I based the price on performance. I looked at the additional $50,000 cash. I'd considered that my $22,000 was additive to the price. It gave me my all-in price. I went to my financing model and said, I still have sufficient debt service coverage. And now we've not only funded We've sold the business at a fair price, but we've also provided working capital for the buyer to operate through his cash conversion cycle. So that's how we would put it all together. Thank you so much for joining us. It's always a pleasure, and it's a whole lot of fun supporting your success, and in this case, supporting your success around understanding working capital in the deal.